we're looking at a pretty good move here upward after a sell-off yesterday. The Dow, of course, sharply lower yesterday. This morning, the Dow is expected to be up about 21 points at the open. But yesterday, it was all about the Fed. Investors concerned about higher interest rates because the minutes from the January Federal Reserve meeting came out showing that the central bank is more confident in the U.S. economy. That could lead to more interest rate hikes down the road. Joining us right now, former Reagan economic advisor Art Laffer. Art, great to see you. Thanks so much for joining us this morning.
Good to see you, Maria. What a team you've got there with Colin, Dagan, and Steve.
Exactly.
My three favorites. My goodness.
I tweeted out this morning, amazing panel, a must-watch right now. So, Art, are you as worried as it seems the markets have been on inflation, on higher interest rates? Because as an economy gets better and grows, you're going to see higher wages, and you may see inflation.
Well, you may see that, but you know what? There's an easy solution to it, I think. It's just king dollar. What we need is a very strong dollar when we don't have control of the monetary base, and we don't because of Bernanke and Yellen. When we don't have that, the only way we can really control things is using the exchange rate. And the dollar's been weak, and that makes me worried, but I don't think it's going to stay weak for long. I wish this administration would go for king dollar. And when you have a strong currency, you can have a strong country and a strong economy. You can't with a weak currency.
Didn't Steve Mnuchin tell us, though, Steve, that a weak dollar is better for trade?
Yeah.
That's silly.
Do you think Mnuchin has learned his lesson, or have you had a chance to teach him the truth of these things?
The last time I was with him was on the tax bill, and he did really, really well on that, Steve. We got better tax bill than I ever imagined we'd get. But no, now we have to work on getting good, sound money, Steve, and you and I have agreed on this forever. And it's very important. If we get sound money, we'll get the correct interest rates. You don't want low interest rates like Yellen and Bernanke did. That's ridiculous. Then you get no supply. You don't want too high interest rates. Then you get no demand. There's the Goldilocks rate, which is just right, which is where markets reflect the equilibration between demand and supply. And we're not there yet. We need higher interest rates, but not because of inflation. We need it because of real returns rising to reflect the better economy.
Do you worry, Art, about the Federal Reserve trying to control the economy, overheating and all that kind of nonsense?
Oh, all my life, that's what I'm worried about, Steve. And all my life, all my fears have been realized. I mean, we've seen the worst stuff in the world, but we've muddled through, Steve, and I think the monetary system is much better today under Powell than it was under Yellen. I mean, I know Yellen, she's great, and her husband was a classmate of mine. They're fine people. They just got a bad model.
What about
and I think Powell won't be as bad.
But Art, you have Jay Powell now tasked with unwinding and undoing unprecedented intervention in markets by the Federal Reserve. With the balance sheet, it's still at $4 trillion. And this, again, letting these Treasury and mortgage securities roll off the balance sheet, this ball really gets rolling later this year. $50 billion every month. And you know what? Nobody on planet Earth, I don't care how many degrees that you have, nobody on Earth knows what's going to happen to our markets and interest rates as that happens.
I thought there was some guy in Manchuria who does know Dagan, but I didn't meet him yet. No, I'm just teasing you. The problem is you've got to roll these assets off the balance sheet. It's ridiculous that they were ever put on there. But now that they're on there, we've got to undo quantitative easing 1, 2, and 3 and Operation Twist. We have to undo it to come back to sounder money than we had. I would like to run monetary policy off the exchange rate and have a king dollar and a strong currency to keep inflation expectations down, just like we did with the real president, Reagan. The dollar from 78 to 85 during that period, I think, appreciated 67% against the basket of all currencies. That's what we need now, and that'll keep the inflation low as it was then. We had a huge boom, strong dollar, and falling interest rates. What more could you ask for?
Are you going to call the Treasury Secretary? Obviously, you made him an apt student on taxes. Can you do it on money now, on the dollar?
I lost his phone number, Steve. Do you have a by any chance, could you do it?
But he already said it, though. You can't unbreak that egg. That's the problem. He already said it.
Oh, yes, you can. Of course you can unbreak the egg, and we should unbreak the egg, and that's what we should be doing right now is unbreaking that egg. We need to go back to sound money, and I think the guy on the sitting next to you right there, Steve Forbes, is my expert on money.
You're not worried at all. You believe in these 3% growth numbers for 10 years out?
I think they're exceptionally pessimistic, if you want the honest answer,
Okay.
Maria. I mean, Kevin Hassett is one of the finest people I know, a great economist, and he now works for the government, which means he's an employee, so he can't say what he probably really believes. I would guess secretly with a little, with an old-fashioned or something, he would tell us that he thinks growth rates can be much higher than that. Under Kennedy, they were at over 5%. Under Reagan, after the tax cuts took effect, they were well over 5% for 6.5 years. Come on. These types of numbers are not impossible. Now, would I be happy with a 3% growth over the decade? Yeah, sure I would be. But I think there's a good chance it'll be higher than that.
Good chance it'll be higher than that when?
Over the next decade.
Okay. All right.
I mean, I think the growth over the last two presidents, Obama, W. and Obama, which are twins, I mean, bad presidents from the standpoint of the economy. And we can offset that and get back to real growth in America. Productivity was 3.2% when Clinton left office. It was 0 when Obama left office.
Well, that's
yikes.
That is a yikes.
Tell me we can't do better than that, Maria. Come on.
Art, thank you. Great to talk to you.
Thank you very much.
Always.
It's really fun being with you.
Art Laffer joining us there.